Well, here it goes, boys and girls. We got ourselves the Fed rate cut decision. Quick heads up, we're 9 minutes away from this. Stockhack.com, we are probably launching out documents and official sign-up paperwork within the next 7 or so days here. So we're really, really excited about that. Oh, wrong mic. There we go. Fix the mic. Sorry about that. Anyway, a quick reminder, stockhack.com, if you want actual personalized financial advice, is expected to launch within the next week and a half here. So we'll have some paperwork starting to go out within the next week. We're really excited about that. So if you're looking for actual financial advice, go check that out and we can personally analyze your situation to get you through all the madness. Okay, with that out of the way, oh boy, this is going to be nuts. We have not been exposed to sort of a surprise Fed rate cut here, or you know, a surprise in either direction, quite frankly, since COVID. So this is weird. You know, going into this meeting with nearly 50% on the betting odds to either side is weird. Usually it's like a slam dunk as to what we're going to get. I mean, I think it's a slam dunk to say we're not going to get 0 and we're not going to get 75. I think that's a slam dunk. But beyond that, whether we get 50 or 25, who freaking knows? You know, this is going to be wild, because the implications aren't so much going to be around what was the rate cut. It's actually going to be around what is the signal of what the Fed is saying. Are they seeing an economy that's not in recession and an economy that can avoid a recession? Like, you want a really, really strong outlook? You get Powell that says, look, we're going 25 because, you know, we're sufficiently restrictive, but we're not in recession. We're not even close. We're at 3% real GDP estimates. We're doing good. Let's just go 25 and boom, market's Gucci. That is potentially going to lead some people to say, wow, I guess you're blind to all the recession signals, and might increase the odds of a recession, or there's no recession. The flip side is, if you get 50 and you get a Powell that's hawkish, you know, he's kind of like, hey, economy's strong, we're going 50 because even down 50, we're sufficiently restrictive, but the economy's good, no recession. Cool. Great. That now reduces the odds of a recession, right? Going 50 now reduces the odds of a recession. So that's the cause for people wanting to go for a 50 here. But, you know, with this, with only a 62% chance, 62.5% chance right now of a 50, really, anything can happen here. Now, the Nick T article and the Dudley talk does lean me to say we're going to get a 50. Mostly because Nick T usually forecasts what to do here, but Nick T did also leave enough in that article to sort of leave the door open to anything. So we'll see what happens. The Wall Street consensus, not the sort of like futures market consensus, but the Wall Street consensus is 25. So if you look at all the different Wall Street economists, there aren't that many on the 50 camp. So the 50 bets could be wrong here. I'm personally in the 50 camp. I'm accepting of being wrong. But you know, I think they should go 50 to minimize the odds of recession. Like, if you want to stick a soft landing, you go 50 here. It's simple. Go 50 and then just say, look, hey, we could always go 0 at the next meeting. But at the very least, we are going to go 50 now. Wow, Olympic Fireball has been a member of the channel for 38 months. Nice. Congratulations. That's an honor right there. Good for you. Wow, it goes back to 2021, huh? So we'll see. I'm going to put my prediction on screen. Again, I could be wrong. I'm not always right. I'm just giving you my POV. And my POV is, I'll get this up on screen in just a moment here. But it's a 50 basis point cut is my POV. Not currently in a recession. I think he'll say that no matter what. I think he will say that rates are still sufficiently restrictive, whether you go 50 or 25. Certainly, if you go 25, you could say that. I do think they'll project a 4% terminal rate at the end of 2024, but if they go 25 now, they probably have to go 4.25, because how could you go for, you know, how do you get to 4% unless you're reducing with a 50 somewhere in there? You only have 3 meetings left. So you need 50, 25, 25 to really get down to, actually, you need more than that. You need like 50, 50, 25. So we'll see. We might get something more like 4.25 by the end. But I think they'll be closer to 4 by the end of the year. And then there's the possibility that you get some profit taking in markets after you get more uncertainty from the Fed. I don't think the Fed's going to give us a lot of certainty either way. Whether you get a 25 or 50, I don't actually think matters so terribly much. I think what the markets think they're going to get here is certainty. And I think they're going to be mistaken. I think the last thing you're going to get here is certainty. You're going to get a lot more of, uncertainty around, crap, okay, like, what does this mean? How do we digest this, So we'll see. Markets don't like uncertainty. Remember the next data sets, or you're looking for jobs data. You're looking for CPI data. That's all next month. And then you're looking for, let's see here. Let's pull this up. Earnings next month as well. So there's definitely some work to be done here. And whatever way it goes, hopefully we don't have a recession. You don't want that. It is bad for everybody. People lose their jobs. People lose their houses, their livelihoods. It's very, very bad. So we'll see. But here we go. We are now just 1 minute away, and Fed meeting. Again, the Wall Street consensus is 25, but the bond market is pricing in a 62% chance of 50. So it's going to be really interesting to see which direction this goes. We're about 1 minute away. The current, I'm going to write this down, the current FOMC rate is 5.5% to 5.25%. As this goes down, expect yields on money markets and savings to go down right away. Expect savings rates to drop by Fed drop right away. Yeah, this is going to be wild. I'm kind of excited to see what happens here. And we are now 40 seconds away. We got the Qs at 11 basis points. Let's kind of tag where we are. Tesla's just over 130. TLT's at 122, which is up really nicely, but it's obviously down on the day. You got Apple's doing well today, up almost 2%. Amazon as flat. Microsoft's over here. So we'll keep an eye on some of these. We'll throw our friend Palantir in there too. And there we go. So remember, folks, no matter what happens in the market, always consider getting a great financial advisor on your team, somebody you can ask any kind of financial questions related to real estate, stocks, bonds, whatever. Go to stockhack.com. Okay, here we go. And it is 50! 50! Woo! We got 50, boys and girls! Oh, let's go!
Of 4 3/4 to 5%. There was one dissent, Fed Governor Michelle Bowman preferring to cut by 25, but 11 voting in favor of 50. It might have been close. I'll come back to that at the end of this report. The statement says the committee will consider additional adjustments to policy based on the data, the outlook, and the balance of risks. The summary of economic projections saying an additional 50 is expected or forecast by the median Fed member for this year for a total of 100.
That's 50, 25, 25.
The median down to 4.4%, or an additional 50 basis points from where we are right now. Another 100 basis points of cuts expected.
Let me read this out faster. Okay, Fed officials see the median Fed funds rate at 4.4 at the end of the year. My thought was 4. The fact that you weren't unanimous is interesting. Bowman being the negative, 11-1. Fed projections imply 50 additional cuts. That's 100 more in 2025 and 50 in 2026. That would take you down 200 basis points from now. That would take you down to 3.25. I think we're going to go way lower than 3.25 to actually spur employment. Policymakers see 2% GDP in 2024 versus 2.1%. Inflation has made further progress towards the 2% objective. Median view of Fed funds rate at the end of 27 is 2.9. End of 2025 is 3.4. Policymakers see, view of Fed funds rate longer run 2.9. Previous was 2.8. That's up a little bit. Carefully assess incoming data, evolve evolving outlooks to risk. Fed has gained greater confidence. Inflation is moving sustainably to 2%. Judges risks to employment and inflation roughly in balance. Outlook is uncertain. FOMC attentive to risks on both sides of the mandate. Sees end PCE inflation at 2.3 versus 2.6, lowering the inflation outlook. Activity expanding at a solid pace, but job gains have slowed. Unemployment rate has moved up but remains low. Quantitative tightening continues at previous pace. No changes here. Bowman dissents. Okay, wow, Tesla jumps on that. The interest rate sensitives probably, I was expecting Tesla and Enphase to move on this. Yes, Enphase moving big on this. I don't know if it'll last because it will, like, Powell's talk could potentially create some nervousness around recession. But yes, obviously, we are expecting a jump in the interest rate sensitives with a 50. Did get a 50 here, as expected for me, but markets were very, very 50-50 on this, which is fine. That makes this entertaining. Now, we're going to jump on over a sec here. We're going to get into the actual document here, and I want you to see all of this in person. So let's go through the documents. We will now make a Fed bingo card. This is crazy. We got 50. And I want to go through this table ASAP. Let's look at the table. Here it is. Okay, here is the table. Change in real GDP. GDP, they're keeping everything at 2%. They are not trying to signal a recession. This makes sense that they're trying to do that. And they're trying, even like 50 signals, they're trying to avoid a recession, right? 50 signals trying to avoid recession. And then this GDP argument is basically what I was saying, which is like Fed doesn't currently see recession by keeping GDP at 2%. Those are their GDP forecasts. You can see they're not really changing any of those at all. That's expected because they're trying to avoid that weakening. Look, once you see that weakening, folks, it's too freaking late. So it's not a surprise that you're seeing this right here. Unemployment rate. Let's see the unemployment rate. They actually see it staying stable at 4.2, but they did revise it up. Look at this upward revision right there, moving up to 4.4% from 4.2, also up 0.2 in 2026, and then this longer 2027 and longer run target here of 4.4. So they do think there's a chance we'll go slightly above, but not much higher than where we are now. Now, in my opinion, that's a little bit of a risk. I'm going to write that down. Fed is not pricing in any additional weakening. Fed is pricing in 0 additional labor market weakening. Okay, now I want you to think about what this means from a trading point of view, okay? If the Fed is currently pricing in 0 additional weakening, then what happens if you get additional weakening? What happens then if things weaken more? Rates need to come down. Okay, so the Fed will have to do more, right? Fed will be forced to do more. They have 0 latitude here for additional labor weakness. Okay, so there we go. All right. Then PCE inflation, you can see they think, I mean, this is almost declaring victory here. And again, I just want to be clear with my initial estimate. My initial estimate was that we would see a positive reaction with a 50 on, I literally mentioned Tesla and Enphase in my video yesterday. I think we'll see a pop in the interest rate sensitives, but as Jerome Powell gives us uncertainty, you could see profit taking and a sell-off. So just be cautious of that. The Qs though right now are nicely up, sitting right on the 476 line, and it's going to be Powell's commentary that really moves us around here. So yes, 50 basis points confirmed. We got 50, baby. Now, my predictions weren't super perfect so far. I got the 50 prediction was good, but we haven't heard the sufficiently restrictive part yet. We'll hear that obviously in the discussion. And then their projection on the Fed terminal rate, I was hoping to be closer to 4. They're coming in at 4.4. So let's see. Keep going here. This projection, look at how low this has come. I want you to see this in just since June, which was the prior SEP. Let me pull up the prior SEP, by the way. Since June, they've come down substantially. You're from a 5.1 at the end to like, oh, no. Because there was a period of time where people are thinking, oh, there are going to be no rate cuts in 2024 at all. And not only are we not getting there are no rate cuts in 2024, but you're actually in a position where you're like, oh, crap, like we're getting 50. Now, I want you to compare this, okay? This right here is the prior table. Look at my predictions right here. Oh, that's interesting. This was my prediction of about a week ago. Oh, look at this. Look what I wrote. Less than 4.6 includes a 50. Let's go. They came in at 4.4. These were my guesses last week. And we were going through kind of what market expectations were. I did think they would push unemployment to 4.5. And honestly, I thought they were going to say that GDP was slowing into 2025. I think it's bullcrap that they don't see GDP weakening in 2025. So I think this number right here is more accurate. I think GDP will slow in 2025. You might even have a recession. So I think them saying 2 here is almost like them putting a floor. Look at the ranges even here. Oh, wait. June project. Okay. Nah. Yeah. Look at the ranges here. Somebody thinks GDP could go all the way down to 1.3 in 2025. So this is just an average, right? Like this is a very interesting one to pay attention to. Kev at 1.5 here or less. And so look at how little consensus there is on what GDP is going to be next year. That's scary right here. That shows you they have no freaking clue on the range. So 1.3 is very, that's on the low side. You're starting to knock on the door of recession. Where are we sitting on the unemployment rate? Unemployment rate could be as high as 4.7. Also not great that we could see the unemployment rate move up that high. I agree with that. I actually think there's a chance it could go over 5% here, especially if you get into a recession. On inflation, nobody actually thinks it's going to go higher than 2.4. So this is almost saying inflation is conquered, right? Almost saying inflation is 1 is what they're doing here. I'm going to write that down. All of them are in the position of saying inflation is sitting in a cured position. So this is almost Fed victory on inflation. Now there's clearly a dispute over the strength of the economy. And you could see that, honestly, this is probably one of the most telling things in this statement right here. Right here, this box is extremely telling because it really shows you just the variety that you're getting and this weakening that you've been getting from the prior projections. Because if I go even over here, look at this. The low in the, in the March projection, the low in March was 1.9. Okay? Look at the low now. The low's gone down to 1.3. So watch this. March 2024 low estimate for 2025 GDP, 1.9%. Okay? And now I want you to compare that to the September 2024 low estimate for 2025 GDP, and it's actually 1.3%. That is a significant weakening in whoever the dove is over there on the dots. So I would really be watchful of that. And then also this expansion of the unemployment rate to 4.7 next year. Let's look at the March projection. March, the highest you thought the unemployment rate was going to be was 4.2. So, and then versus 4.2 for unemployment. I'll just kind of steal that line right there and we'll throw that right there. And then we'll do versus 4.7 for unemployment. So you're really seeing the weakening over time here. And that's really what drove a 50 here. Now, again, while you could get a temporary pop, I just want to be clear, while you could get this temporary pop on the interest rate sensitives, you have to now switch to this concern over, crap, what does this mean for the economy? Is this does the Fed see a potential recession? I'm starting to see, by the way, outflows in just the last couple. We had inflows as soon as the cut was announced. I'm now getting outflow readings on NASDAQ and New York Stock Exchange. So I'm watching that. Those outflows seem to align with some of this profit taking, right? This was one of my predictions, was that we'd get 50, but you'd actually start getting profit taking. Now, I understand there's even profit taking on bonds today. That's okay. Like a 50 should be fantastic for bonds, like bond yields should fall. But no, people have to take profits first because they're confused. Like people take profits and go, what the hell is going on? Crap, what does the Fed see that we're not seeing? So you're going to get initial profit taking, again, my expectation, and it's really going to come down to what Jay Powell says, because we want to see debate on this consensus breaking, right? Let's write this down and be very clear about this. This is the first time since 2020 we've had I think we're at over 2 years. Hold on, I have this. Okay, let me see here. Consensus. No. Unanimous. Okay, let's see here. No. Dang it. I want to say it's the first time since 50. Oh, here it is. No dissent in the last 2 years, right? So this is the first time we have a dissent in the last 2 years. I really want you to think about that. First dissent in the last 2 years. And that's Bowman, who wanted 25 on 11-1. So what does that signal to you? It signals that even though Jerome Powell prides himself so much on consensus, he couldn't get it. First time since 2022, 2 years, that we have not had consensus. Bowman, who really just joined the voting committee anyway, Bowman couldn't go for 50, stuck with 25. And what that does is it tells you they don't really know. They don't have agreement on the state of the economy, right? So no agreement on state of economy. In uncertainty, they are hedging against recession by going 2020 or by going 50. This is somewhat bullish in Kevin's world, but markets may see it as worrying or worrisome, right? And so this is, again, where you think profit taking is possible as people sort of let the dust settle and just come back closer to the election. You know, that's kind of what my fear has been. Let's see. I want to see. I mean, the dots here are just visual representations of what's on this chart. PC inflation. Inflation's really won here. They do not see any pop-up inflation at all. In fact, if I go to the March statement and I look at the PCE trajectory, you could see that they thought you could go up to 2.5% on inflation. Now only 2.4, right? So I'm going to say down from 2.5 in March 24 SEP. It's just useful to have those little notes here. Okay. Oh my goodness, I hear screaming children. I have a lot of children, so I'm going to close the second door really quick. Let's just listen in here for a moment.
We're almost guaranteed.
Somebody named LOL says Kevin's coping, rip his shorts. How many times do I have to say I don't have shorts? The only shorts I have are the shorts I'm wearing. You want to see my shorts? Maybe I'll show you my shorts. I mean, maybe there's some ladies who want to see the shorts. But no, I don't have any shorts. Little tiny exposure to a short Bitcoin position. But no. I actually have call options. I have like $2.5 million of call options that I think will do exceptionally well with a 50. Just give it a few days, and they'll do exceptionally well with a 50. So no, I don't have shorts. Yeah, show us the shorts. I'll get a child first. Hold on. Let me put this on.
Right now, about half the curve is above where it was yesterday on the close, meaning 7-year, 10-year, 20-year, 30 years or higher, but it's starting to creep down the curve. The equities have given up some of the ground, and the interest rate complex first initial reaction was a rally pushing yields down. Then they bounced back. Now they're coming back down. It's going to be a big two-way trade, probably till Q&A. But what you really want to pay attention to is the yield curve. Right now, it's steepened about 5 basis points, meaning long-term Treasury rates are a little more stubborn in terms of coming to the game and rallying, pushing yields down. And ultimately, if you listen to our panel, pretty much every guest we had on today, you know the good side of what the Fed did. But the other side you're going to hear a whole lot more about in the next 15 hours. 50 basis points.
Yeah. Okay, Rick, we'll see a lot. So I want to introduce everybody to my Jay. This is Jay. He's a big boy. He's our biggest boy. He's got this funny face with these giant cheeks. But he's so cuddly. And he's a happy little boy. And his name's Jay. What's up, Jay? But anyway, he's here to keep you company for the next 13 minutes. Well, maybe he won't last 13 minutes. But he's here for a little bit while we wait for Jay Powell. And, yeah, it's pretty crazy in here, huh? Yeah, huh? So he also likes Luigi. And what else do you like? You like food. This guy eats. This guy can eat. He's the biggest. This guy is just as big as the other babies that we have that are about 5 months older than him. So it's kind of crazy. But anyway, let's keep going with this statement over here. So the statement, like, I want to see what else we have. Federal funds rate. You know what I'd like to do would be we'll look at a red line in just a moment of the actual statement. Actually, you know what? Maybe we should do that. Let's go to a red line. The red lines are always interesting because then we could see, you know, just the various words that were changed. I can usually get those pretty quickly. No, nobody has a red line out yet. Are you serious? That's crazy. That's fine. But we read out the statement. I will see what has changed here in just a moment. I want to see what the suits are saying. It's good that the Fed has now recognized the weakening of the labor market and responded with an aggressive cut. Given that there's almost no risk of rekindling inflation, the greater boost to the labor market is, let's see here. The greater boost to the labor market is largely costless, will help spur the housing market. That's true. Could help mortgage rates here. Yield-driven dollar bearish narrative has dominated since it was validated by 50 basis points. Yes. Let's see here. As we noted earlier, markets were quite divided. Just 9 forecasters out of 113 at Bloomberg economists predicted a 50. Boom, baby. Your boy me Kevin was one of them. Well, no, I'm not an economist. Maybe I should go to school and become an economist. I've taken a lot of economic classes. I love economics. But anyway, yeah. What do you think, Jay? What do you got? 50, buddy. You gave us 50. Huh? Yo, you think that's funny, don't you? You're 50. Yeah. So, okay, let's see. Pretty one-sided. Huge victory for Jay Powell. Kudos are already coming in from Democrats, many who have been calling for a bigger... Oh, I can't wait to see what Trump says to this. That's going to be funny. I'm going to go to Truth Social really quick just to see if there's anything from Trump on this. Nope, not yet. It's been like 16 hours since he's posted over there. But a statement is clearly dovish, stating risk in the economy, switching from inflation to employment. Dots look interesting. That's fine. Tweaks to the language include job gains have slowed, okay? Says inflation has made further progress, but remains somewhat elevated. Statement says committee has gained greater confidence that inflation is moving sustainably towards 2%. Statement notes risks are roughly balanced. Yes, indeed. Roughly balanced. Huh, Jay? So we got to make a bingo card now, okay, Jay? All right, Jay, man? You're such a jerk. You look at those smiles. His cheeks are so huge. Your giant cheeks. Okay. Let's see. Somebody's saying gold running. Bonds are roughly flat. Oil slightly down. Gold up another %. Nice. And then, let's see what they're saying here.
Welcome back. We've seen whipsawed markets after the Fed's decision at 2 p.m. to cut interest rates by 0.5 point. The Dow had been up to session highs, all-time highs, in fact, briefly turned negative, is up 188. S&P's up 0.5%. NASDAQ, the highest, up 0.8 or so. For more on what investors need to know, Mark Avalone is here. He's president at Potomac Wealth Advisors. What are you advising, Mark? Welcome.
Ooh.
Well, welcome.
Yes, what are you advising?
It was a big surprise for me. And
Yeah.
I think investors shouldn't go out and make any knee-jerk responses. But I think there's going to be some opportunity here. I mean, we've talked about the relative valuation differential between small, mid, and the large cap, mega cap. I think a lower rate environment is going to serve small and mid cap well. So that allocation, still not too late to get there. Again, it's literally about 50% on a forward PE of what the large cap, mega cap is. So we find that attractive. We also think investors, whether this is a slowdown, 50 basis point cut, or a preemptive, we want to get out in front 50 basis point cut, we think technology is the way to go. I know I've been a broken record, but...
Buy tech! Oh my God, another one of those people. Everybody, quick. I got NVIDIA. Come on, man. That's the diversity you get from the financial advisor space, man. It freaking kicks my ass. That's honestly, I didn't want to get into financial advising, but we created StockHack.com, which launches next month, because there's so many advisors. It's just tech, and we're like, how about real estate? No, we don't get a commission on real estate. We don't do real estate. I get it. Maybe your company doesn't, authorize you to advise on real estate or whatever, but it's so rare to see somebody, a real estate broker and a wealth advisor. So we're really excited about that service at StockHack.com. We know we don't expect overall it to be the cheapest, but we think it will be one of the best for long run wealth building. It's not like trading or speculating. It's actually you just being able to text my team in the office. You get your blue iPhone texts if you want that, or green if you're Android, and just talk to us. How can we help you? Okay, let's get some more suit reaction here. After today's cut, the real interest rate remains high by historical standards. That's why I think Jay Powell's going to come out and say, look, we're still sufficiently restrictive here, right? We don't need to really think that 50 isn't sufficiently restrictive. We do only have 7 minutes to make a bingo card, so we really have to jump to this. But let's see here. Job gains have slowed. I think that's one of the most notable kind of comments from the statement. Let's go make a bingo card here. Insert. We have to be very fast on this. So if you don't mind, give me your suggestions for what we should have on our Fed bingo card in terms of your expectations. Now, we are going to listen to the Fed press conference together in just a moment. I'm generally pretty quiet during the press conference, so obviously I encourage you to hang out. But if something crazy happens, I'm going to say something right away. So, and I think that's really, really important. I don't know that I want to say that Nick T is going to be next to Smilyak again. I usually say that. And I think we could do a freebie as the purple tie. The purple, hold on, 1, 2, 3. Oops, I went too far. No, is that right? 1, 2, 3, 4, 5. Yeah, okay. 1. I have to remember, when you draw a bingo card, you only need to make 4 lines. It's not that hard, Kevin. But surprisingly, I still suck at it. Maybe if I had a template or something, that'd be cool, right? So let's put that in the middle. Powell, purple, tie. Okay, that's what we're going to go with. Powell, purple, tie. I'm going to do mine really quickly first because I want to get bingo this time. Okay, ready? So we're going to go still sufficiently restrictive. I'm going to put over here, labor market weakening can be self-sustaining. That would be a red flag. Still sufficiently restrictive. Then can cut more if data deteriorates further. Right now, not in recession. Not in recession now. Not in recession now. And GDP growing strongly and better than expected. I'll write that down. That's going to be my sort of bingo row there. Okay, somebody soft landing, data dependent. Oh, he's certainly going to say data dependent. Data dependent. Doesn't care what Donald Trump thinks. Yeah, politics. We don't consider politics. That's an easy one. That's good. I like that. I like it. Dual mandate. Yeah, I mean, some of them are going to be very, very obvious that he's going to do that. Tools on the tool belt. We have the tools. I like that. We have the tools. That's a good one. Then housing. Leading rent indicators flat or soft, suggesting owners will come down. Right? Inflation battle not over. He's going to say that because he doesn't want to pretend like they're declaring victory. But progressing well, right? Something like that. Talk about the taper would be nice. Ending quantitative tightening talk comes up. That would be huge if we could get some QT talk. All right, I'll do it. Nick T goes back to Blondie from New York Times. Wall Street Journal and New York Times, that's like left and right there. That's how you have a balance. Take it meeting by meeting. Yeah, we have to also put in meeting by meeting. I like that quote. But then we should also put in no decision yet on November meeting, right? But then we could also say November could be 0 cuts. I think that's the way he's going to sort of defend this. Blonde is married. Well, I don't care. I want to see them sitting next to each other. I'm not suggesting they're in a relationship. Som rule comes out. Okay, we could do that. Som rule. Claudia Som came out and suggested that, she's right there.
Really explain what it is and the criteria that they're going to use as they go forward. Powell's strong suit is his communication and an ability to just say it. And I think that's what they will lay out today in the press conference, and that's what we absolutely need. So he needs to bring that.
As you say that, I think back to his hawkish press conferences that used to upset the market. They would come out with something at 2, the reaction would be relatively ho-hum, and then he'd start to talk, and we'd kind of get this big sell-off. Mm-hmm. Is it now? So I thought going into today it might be the opposite, where maybe they go 25, but then he's quite dovish, as he has been kind of going back to Jackson Hole and talks about labor market. Now that they've gone 50, I don't know if I should expect dovish Powell or more moderated Powell to explain, no, the economy's not that bad, and so I'm just trying to think through this.
It is clear because of where the decision landed that the Federal Open Market Committee had a lot to talk about.
He comes out with no tie because he was just in a fight. I like this hawkish, going hawkish. He's hawkish in the discussion. Well, if he's hawkish, he might undo, some of the rates progress here. But he's hawkish in discussion. I'm going to put it though by suggesting. Economy strong now. I got three more. Give me 3 quick ones. Quick. We got 30 seconds. He comes on stage with a cat. What is this? He's not going to be late. He's going to be on time. We already got that. Risks in favor, risks to downside in labor. Let's see. He uses paper instead of iPad. I'm going to go paper instead of iPad. And the last one. Come on. We have not discussed the next meeting. Yeah. Next meeting will be live. We'll say that. Next meeting will be live. They like that word. Okay. All right. Ready? Take a screenshot of this. Take a screenshot of your bingo board. All right, ready? Should be out any second now.
But I think we got to look back at the pandemic was the root of evil.
We have to leave it there, Claudia, as the chair is
Laptop.
now ready to speak. Let's listen.
What the hell is this?
I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%.
That's basically declaring victory.
As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed that made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, but the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year.
They're next to each other.
Does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level, so that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral, and we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
By the way, in honor of the 50 basis point cut, we are doing a 24-hour flash sale. MeetKevin.com, Stocks and Psychology Money Group.
How close was this in terms of the decision? You do have the first dissent.
See my $2.5 million call option trade on this Fed 50.
Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right?
Wow.
7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Yeah, 4 or more. That's my guess.
This is in the books. Can you give us some guidance as sort of
turn his mic on.
The pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik with the New York Times. Thanks for taking our questions.
There she is.
You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see
that's why 50.
Rising, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Okay. Right here, he's hawkish by suggesting economy is strong now. Okay.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. So I would say we don't think we're behind. We do not think we're behind. We think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred
Good job,
about
Nick T.
How the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Okay, it's another tool.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on The point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So
Yes.
our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. And we're not hearing that from companies, that's something that's getting ready to happen. So we're not waiting for that. Because, there is thinking that the time to support the labor market is when it's strong and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Okay, fair.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a low. That's a very healthy unemployment rate.
I knew they would do that.
Anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased, and because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do
expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell.
October 4th jobs report, November 1st jobs report, October 10th CPI, November 13th CPI. Write those down.
Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs,
immigration,
you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Quick shout out to those of you taking advantage of the Fed flash sale in honor of 50. Sergio, Matt, Ruben, Jacob, Francisco, Josh, Nicholas, thanks for joining the Stocks Insight group. Lifetime access, you pay once at meetkevin.com. 24-hour flash sales on now.
Has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this?
Yeah.
It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah. So this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene. Thank you, Chair Powell. I'm Jolene Kent.
NASDAQ just went negative, and things are starting to fall now, which I kind of suspect that there might be profit taking after this meeting. It's kind of what we predicted. Anyway, you want more of my insights and trades and ideas, my $2.5 million call options, meetkevin.com, flash sale.
And our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
Yep.
Yeah.
So
let's see.
Housing inflation is the one piece that is kind of dragging a bit, if I can say.
Yes.
We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more.
Inventory will go up.
What's the likelihood of that, and how would you react to that?
We don't know.
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home. So
watch this. Inventory goes up.
Very low mortgage to be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, you know, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much.
There is a lot of profit taking happening right now. Like everything's just kind of turning red right now.
To run versus just the labor market is strong. And then also
It's 10-year profit taking, by the way, for those of you wondering why the yields are going up.
Do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, you know, business people who are actually out there doing business. So I think, you know, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, you know, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but you know, we might well have. I think that's not, you know, that doesn't really answer the question that we ask ourselves, which is let's look, you know, when at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So, this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, you know, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households? Well,
what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. You know, we just keep it low, keep it stable. We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. You know, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I'd sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday, you know, after the CPI number came out? It was a really small probability.
Before Nikki leaks.
Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so importantly?
Sure. So countries that are democracies around the world.
Here we go. The whole Venezuela argument about this is what kills countries when politicians have control over monetary policy.
People have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we're not, we do our...
Right, because there's deemed to be more trust, blah, 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 blah. A shout out to somebody who just signed up again on the Fed flash sale for Fed 50. Charles signed up for a bundle here, gold and stocks and psychology money group. Awesome. Ding, Marjana, Pedro, Jesus, Sunil, Matthew, Akshay. I may have messed that one up. Anyway, thanks for signing up to that. Remember, we're also now starting personal wealth advising, actual financial advice all year long for the years going forward. We can build a relationship with you and help you manage your wealth over at stockhack.com. We're launching that service within the next week and a half. So get in line over there if that might be of interest to you by signing up at stockhack.com just to be on the interest list.
The Basel III Endgame. I'm wondering if you are...
Oh, the flash sale is meetkevin.com, by the way. Stocks Insight group. You get to see my $2.5 million bets and how I'm going to reposition, what I do, and stuff like that.
And if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday, there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. That the stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Wow. Okay, we need to do a whole summary of all of this. This is amazing. This is a lot to unpackage here. The first rate cuts have begun. Well. Thank you so much, first of all, for being here and watching it with me. Meet Kevin. Let's do a summary of everything that we just discovered here. Shout out to those of you, again, signing up for the Fed 50. I made a bet that we're going to get 50 basis points of cuts. We talked about the plan this morning. We'll see how it plays out. We'll see how we reposition. We expect profit taking in the markets across the board after this event. And then tomorrow and the next day and quite frankly into next week, I think we're going to see a real rebalancing in markets here where markets are going to go, damn, we know they're saying they're not declaring victory on inflation, but they kind of are. We know they're saying we don't see anything that would cause a recession. Duh! Dude, imagine if he came out and said, hey, we see a recession on the horizon. You'd cause the recession. You would literally single-handedly cause the recession by admitting it. So I think you're going to have a lot of recalibrating by investors here. You're going to have a lot of people that are like, okay, all right, well, damn, we were not expecting 50, so let's take some profits on some of the moves we've had over the past few weeks and kind of see where do we go from here. So I think that's kind of where we sit right now. Let's do a full summary of what's going on here and then kind of analyze the markets a little bit. Quick reminder, thank you so much for those of you signing up for Fed 50 on Stocks and Psych. You get lifetime access to the course member live stream. So every single Fed meeting for the rest, as long as I sit here and do YouTube, which I expect to do for a very, very long time, it could be 20 years, you get to see my analysis in those course member live streams and moves I'm making. So even if I'm wrong now, although we were right about 50, even if I'm wrong now, you get to see other predictions in the future, and we love doing this every single day. So join those course member live streams. You pay once, you're in forever. Okay, let's get started. So let me hit the little record button. Button right there. Well, holy smokes, it is official. The Federal Reserve rate cuts have begun. Expect to get some emails in your bank account suggesting, hey, it's your banker. Your savings rate is now down by 0.5 percentage point. Now, Jerome Powell calls this a recalibrating of policy. And one of the things he left off with is suggesting that he sees no indication that we are presently in a recession, at the same time as he also suggests we're not willing to declare victory and we are not declaring victory on inflation. But both of these, in my opinion, are straight up lies. I think that the Federal Reserve is declaring victory on inflation. I'll show you that on the summary of economic projections in just a moment. Not only do I think the Federal Reserve is declaring victory on inflation, but I think the Federal Reserve realizes if they came up in front of a nationwide audience and said, yeah, there's some recession risks, you would see the market so quickly sell off that you would literally create the very recession you are trying to avoid. This is why, of course, Jerome Powell says, quote, I don't see anything in the economy that suggests the likelihood of a downturn is elevated. We don't see that. You see growth at a solid rate. You see the market very solid. I don't really see that. That was his line on recession. But wait a minute. Let's take a look at the summary of economic projections. Does that align with what your staff is thinking? Because see, in this summary of economic projections, what I've done is I've compared the March 2024 estimates y'all gave to the current estimates for next year. And in March of 2024, we had a low estimate for the 2025 GDP of 1.9%. Right now, that low estimate has moved to 1.3%. Note, that's the range, right? They expect it'll be average around 2%. But someone at the Fed thinks it could go as low as 1.3. The lowest low estimate was 1.9. Now it's 1.3. The Fed sees the weakening in GDP. Notice Jerome Powell did not once suggest, the Atlanta Fed real GDP says GDP is growing at 3%. Why wouldn't he mention that? He doesn't mention that because that is extremely misleading and would send a signal that they're blind. Instead, he says, GDP is progressing at roughly the similar pace now as it was at the beginning of the year at about a 2.2 percentage point pace. Interesting. So if GDP is expanding at 2.2% and you think there's this downside risk, we could go potentially, somebody at the committee thinks we could go as low as 1.3, which again, the previous low was 1.9. And the previous low for the unemployment rate was 4.2, and now it's 4.7 the previous high estimate was 4.2 for 25, and now it's 4.7. It kind of suggests that there's some folks over at the Fed that are going, no, things are weakening more than we expected. And Jerome Powell did indicate that in this meeting as well. He tells us very clearly, hey, the jobs market has started to weaken substantially, especially when we look at job openings. Now, Jerome Powell is trying to put a floor under that. Think about kind of like a line on a chart plummeting, and he's trying to put like a support underneath, like on a stock. It's like, okay, how can we stop the collapse? That's why we got a 50 basis point cut today. They're trying to put a floor under that labor market slowdown. But it actually makes me nervous, and I'm going to give you my predictions for what I think is going on. And I'll show you what my predictions were going into this, and we'll check those. But first, In honor of being right on a 50 basis point cut, I told my team we would not do this unless I was right on 50 basis points. We went from having no coupon to having a Fed 50 coupon. So in honor of being right, for being basically one of the few to suggest 50 basis points, 9 out of 115 Bloomberg economists thought we were going to get a 50 basis point cut. We got a 50. A lot of people were like, you're crazy thinking 25. Anyway, I was thinking 50. People thought I was crazy for thinking 50. We got 50. And so we did a flash sale. It'll expire tomorrow at lunchtime. It's kind of a weird time for it to expire, but 24 hours basically. Fed 50, go to meetkevin.com. You get lifetime access for life to all my trades, including my $2.5 million in call options, other allocations that I'm making, where my head is on real estate, the real estate market, the stock market, future Fed meetings. It's not like you're just buying now to see, okay, you know, what's Kevin doing right now. You get that lifetime access. So consider that by going to meetkevin.com. But let's compare some of the other things that were said. First of all, we have the following. My predictions going into this were that we were going to get a 50 basis point cut. We got that. We are not currently in recession. We got that. And of course, the Fed wants to be vigilant and that rates are sufficiently restrictive. We got that. The Federal Reserve did project a higher terminal rate than I expected, 4.4. I was looking for 4. And profit taking ensues. We'll have to really see how things move over the next couple days to see how profit taking ensues. So far, it seems like there was some profit taking, but we're trying to get back to that 476 line on the NASDAQ 100. So we'll see where that goes. Now, something I want to point out to you is over here on the FOMC statement. Look at this. Right here, they projected a 4.4 at the end of the year, which is a substantially greater set of rate cuts than what we had in the last FOMC projection. If we jump to that last projection, you could see that I wrote here, if we get less than a 4.6, we're going to get a 50. And that's exactly what we got here. We got a 50 basis point cut because I think the Federal Reserve is starting to recognize there is weakening, but we don't want to panic anybody. So we're going to have a hawkish conference, right? We go 50, have a hawkish conference. The economy is fine. No recession. Everything's fine. He literally said, the economy is fine. Those were quoted. I saw it even pop up on terminals. People like Powell, U.S. economy is fine. And it kind of just reminds me of like that cartoon meme where, you know, the guy's sitting there with the coffee. Everything is fine and everything is on fire right behind him. Consider for a moment why they ended up cutting 50. They not only used the incoming payrolls data and suggested that maybe had they had this data earlier, they would have actually cut 25 in July. But they also said they're starting to see anecdotal warnings in the beige book of weakening in the various different bank sectors throughout the United States, that is Fed member bank sectors, and that's why they cut 50. They're trying to, they don't think they're behind, they don't want to fall behind, but they also acknowledge that they're not in a rush to get this done, that they're going to remain data dependent. This is not surprising. But listen to this. All 19 members at the Federal Reserve who were part of this decision, 12 of them vote, but 19 are part of it. All of them part of the Summary of Economic Projections. All 19 wrote down multiple rate cuts for this year. Just in the last Summary of Economic Projections, very few were writing in multiple. In fact, there was a talk that we would only end up getting one rate cut this year. 17 officials wrote down 3 or more cuts. 10 out of 19, so more than half, wrote down 4 or more cuts. Jerome Powell says the economy is in good shape and the labor market is in a solid position. He does actually compare the labor market. I was worried they were going to do this as a way of being hawkish, and they did. We warned about this in the days before, and they pulled it out of the bag. I was worried they were going to say, well, you know, historically, 4.2% unemployment is really low. That's bad. You don't want Powell going, oh, well, 4.2 is historically low, because it potentially means they're willing to be a little bit more cavalier with that jobs market because it seems like it's in a good place. But once the economy starts slowing, it's an inertial movement that's hard to stop. This is why Powell was asked, hey, usually when the unemployment rate goes up 1%, it proceeds to go on yet another 1 to 2 percentage points after that. Isn't that bad? And Powell says, well, that's why we're going 50 to try to stop it now. So he recognizes the trend is down on unemployment. They're trying to stop it with 50. But in the same conference, he also said, well, we're not political because after all, there's a lag in, how long it takes for rate cuts to hit the economy. Okay, cool. So the federal, unemployment rate is at a level where you want it now, but your rate cuts are going to lag to help the unemployment rate. So in other words, the unemployment rate might actually weaken further, might rise further before your rate cuts even take effect. Jerome Powell basically declares victory by suggesting that our patience has paid dividends. The base case is getting to a more neutral level. They're right now pricing in rate cuts of about 200 basis points would take us to about 3.25% into the end of 2025 through this easing cycle. That is a little bit less than what markets were anticipating. So you are getting a little bit of a take profit in some stocks, and you're getting a little bit of a take profit in some bonds. But it's probably not going to take a lot of thinking or data to indicate that the economy's still slowing, and all of a sudden you'll actually see rates move slower. That's my estimate or my guess. Now, if we actually look at the world interest rate probability move after this, I can tell you that right now, markets are actually pricing in a 35% chance of a 50 basis point cut in November. So look at that. We're already moving to that forward data. Something else to pay attention to are the next data sets, which Jerome Powell pointed out as well. October 4th, we're going to get a jobs report. Mark that on your calendar. October 4th, jobs report. October 10th, we'll get a CPI report. I'll cover all of these live. November 1st, we'll get a jobs report. November 13th, we'll get a CPI report, which is after the election, after November 13th. I personally expect a lot of volatility between now and the election because now, as we suspected, the Federal Reserve doesn't actually provide really clear clarity. And instead, now all of a sudden, you're basically declaring victory on inflation, but you think your lagging rate cut is going to help the labor market. It's going to make us more data dependent. So what are we going to look at? Q3 earnings in October and the jobs and CPI reports. That uncertainty could increase the risk of more profit taking. As far as housing, Jerome Powell says that housing inflation has been dragging a bit based on the owner's equivalent rent sector. This is something we expected as well. But as long as market rents remain in control, the outcome is not in doubt. Basically, he's saying, look, market rents are essentially flat. We've looked at this as well. Housing rents are a lagging indicator as part of CPI, and that's one of the last parts that's hot. So he's basically declaring victory on inflation here. And he does argue that as rates normalize, more people will sell, and that'll normalize the housing market. This is an argument that I had as well. I haven't been saying that I think housing markets are going to skyrocket just because rates come down, mostly because I think inventory will come up on that. And we've already seen mortgage rates come down quite a bit here. So you really have to watch the 10-year Treasury to see if mortgage rates are going to come down even more after this cut. So far, yields are actually slightly up. Yields are slightly up at the moment, probably for a few reasons. Number one, profit taking, very, very high likelihood, just because we had such a good run going into the Fed meeting for bonds. But the second thing is they did mention that they have no intentions right now of a slowing QT, quantitative tightening. So that could be another reason as well. Worth noting that gold went from being up one and about 2%, 1.2% to about down 0.37%. So you've had a little bit of an unwind there of some of maybe the recessionary fears. And this was part of sort of my bingo card, which I didn't get bingo again, but we had it seems like I'm always off by like one on the bingo card. I'll show you the bingo card really quick if you want to see what I got. But on the bingo card, I did mention that ending QT talk comes up. I got, a mark on that. He's hawkish in his discussion by suggesting the economy is strong now. We got that. Yep. We got can cut more if data deteriorates further. Yep. Powell's on time, purple tie, Nick T sat next to the blondie, meeting by meeting, no decision yet on November, risks to the downside in labor, don't consider politics, owner's equivalent rent lags, but market rents are good, we wrote that down. We didn't get anything on a self-sustaining labor market, although he was roughly asked that. He used a laptop instead of paper. He didn't say we're still sufficiently restrictive, though that was implied that November could be zero, but we're pricing in a 33% chance of 50 and pretty much a certainty of 25, mostly because of the summary of economic projections. SOM rule didn't come up, little typo there. Data dependent is sort of by default something they always mention. I'm sure that was said, but it wouldn't make a difference to my bingo card anyway. Okay, then what else we have? So let's see here. I just want to make sure I got all my notes covered because there's a lot here. So we got the 50, which was great. We got job gains have slowed. That was the change in the statement. Strength in the labor market can be maintained, and the economy can continue to grow with modest growth. So they're basically trying to draw this picture of a soft landing, which is, hey, like, things are softening, but, we could probably keep going with this softer pace and be okay absent a recession. Again, I think they have to say that, because, frankly, if you say you're going to go into a recession, they will induce a recession immediately. Let's see. Generally expect GDP to remain solid. Notable step down in the labor market. Labor market is not a source of elevated inflation. Our patient approach has paid dividends. Basically, again, declaring victory on their approach here. Economy is in good shape. This is that hawkish talk of basically like everything's okay, this is fine. Watching the labor market further, though, we don't need any further labor market weakening, he reiterates. And the economy is basically fine. Again, I think of that meme. And then again, refuses to acknowledge that maybe the odds of a downturn or recession have increased. Again, I dispute that, I agree with that, but that's the cool thing about markets, is that everybody can have their own opinions. What matters right now is that we got 50. That actually does reduce the odds of a recession, but it's lagging. The question now is, has the Fed waited too long at this point? And quite frankly, volatility in markets and data over the next probably 4 to 5 months, maybe 6 months, will really let us know, are we going to stick a soft landing here, or are we going to go for a hard landing? Too early to tell right now. Either way, whatever happens, make sure that you're a member over at meetkevin.com. Join me at meetkevin.com. Shout out to those of you joining using that 24-hour flash sale. You get to see my 24-hour or my trades on Fed 50. Thank you so much for joining. Chad, Gesson, Herdonley, Wesley, Joshua, Timothy, thanks so much for joining here. Appreciate all of you for the support. Remember, you get lifetime access to these. Can't guarantee I'm always going to be right. I can basically guarantee you I'm not always going to be right. No idea how the market's going to move in the very, very short term. But I think we've got a nice handle on how we build out positions for the longer term macro moves. So feel free to join us in the course member live streams to see those analyses. Let me know what you think. Were you expecting a 50? Only 9 out of 115 economists surveyed by Bloomberg were expecting a 50. Nailed the 50 bet. Now the question is, what are markets going to do? They're pretty stable right now. And so the question is, what happens over the next few days? What do we price in for that November meeting? And what do we have to look forward to for the rest of this week? Not much. Not a lot of data at all this week. We don't really get PMIs until next week. We'll get initial jobless claims tomorrow, but who cares? And that's all I got. So go to meetkevin.com, use that Fed50 coupon code. If you want actual financial advice, by the way, do check out stockhack.com. I just want to give you a warning. It's going to take some time to onboard everyone just because so many people have signed up to the interest list already. We're probably going to go in order of people who have signed up. Expect this website to be updated within the next day or two with a larger table on everything that's included. It's not the cheapest service, but we want it to be the best service. I'm going to put up a new video. We're going to put a lot more detail in here on everything that's included. It's going to be pretty amazing. We think our asset management fees are actually very reasonable at 69 bips. We do have a monthly fee, but that's because we're not going to charge hourly. A lot of financial advisors will charge hourly. And one of the big things that makes us different, people ask what makes you different, is that we're actually going to be able to help advise you on real estate. I don't think, I'm biased, obviously, but my opinion is I know a lot about real estate, and I'm so willing to help people on real estate. And I just don't see advisors in the financial advisory space talk about real estate, usually because, I hate to say it, but there are no commissions in real estate for advisors. So there's really no incentive. But we're a commission-free model. We don't charge an hourly fee. and we can help you with renovations, real estate acquisitions, retirement, stocks, crypto, insurance, bonds, you name it, crypto management, you name it. So we're really excited about this. So sign up on the wait list. It's coming October 1st. But again, we're going to phase in probably in the order at which people signed up on the wait list, how we can actually onboard you. Since onboarding is the most time-intensive part, and then working with you regularly, texting with you, calling with you, emailing with you. You know, you want to blue text your financial advisor, we have that opportunity for you. So you'll be working directly with my team, who's always a radio call away from me. That's the other thing. I'm either in the office with the team or I'm a radio call away. Hopefully it doesn't like Israel blow up on me. You know, I got quite a few devices here, and it's just so I can always be in touch with my team. So that way, no matter what questions come up at any business, whether it's house hack or stock hack or whatever, like I'm engaged, man. My team can get a hold of Kevin. I got the phone, we got the radios. You know, I could have like 3 bombs here right now. You know, this is all for you. Look, I'm risking my life putting radios in my face for you. So, see this one? This one's really cool, by the way. This one, this is an LTE radio, which is cool because I can take it around. This one right here with the giant antenna, encrypted local network. It doesn't go over anybody else's network. It's my own antenna because we built an antenna in, and so we have our own. Anyway, only radio geeks probably care about that. I care about that. I think it's really cool. Anyway, thank you so much, seriously, for being here, folks. I love all of y'all. I'll keep bringing information to y'all. Let's see what happens in markets. The Qs did just turn red. Again, I personally think the level of uncertainty increase that we're going to get between now and, frankly, the election is going to be massive. I mean, think about it. You just got the best news you could have. You just got the 50, okay? So you got good news for the markets. Now everybody's like, cool, I'm going to take profits. And now you go into a low liquidity time with Q3 earnings coming up, 2 jobs reports coming up before the election, 2 jobs reports before the election, low liquidity as we go into earnings, stock buyback blackouts, and people that are kind of like, I don't know, was the Fed too late? Or are they seeing something we're not seeing it? I mean, read the Fed Beige Book. The Fed Beige Book freaked them out and made them go for a 50 BP cut here. Fed Beige Book was, what was it? 9 out of 12 districts we're seeing signs of weakening. That's anecdotal, right? Those are leading indicators. So I don't think it's all Gucci out there. I think the Fed is doing the right thing by going 50. So I probably on the bear bull scale, for those of you wondering, I said that 50 would be more bullish. I did kind of anticipate 50, so I went to 3.5 on the bear bull scale. I'm probably at like 3.6 right now, but it's not where I'm like so excited about where valuations are in markets and where I am. But yeah, I mean, like, do I smidge up a little bit because of this on the bear bull scale? Fine, but 3.6 is certainly not making me want to run into stocks going like uber bullish all in on margin right now. That recession risk is still very, very present, and I think it becomes substantially more evident and prominent over really the next 4 months here, especially January, like a January layoff period. If you get a bad October, January layoffs could be bad. So, those are just little things to watch for. So on bear bull scale, 3.6. So that's my take. Anyway, if you don't already know, by the way, you could watch totally for free my market open live streams every day the market is open over at the Meet Kevin live channel, Meet Kevin Market live channel on YouTube or on X. You can follow me on Instagram at RealMeetKevin, and that's all I got. So meetkevin.com, 24-hour flash sale on the Stocks and Psych group and the other courses if you want to bundle up. If you have questions, staff at meetkevin.com, stockhack.com. Get in line for the financial advice if you're interested in that. And good luck, everybody. I really do appreciate all your support. I couldn't be here without you. And all I could promise is that every single day, I'm going to do my best to just keep working hard for you, even if I F up. So appreciate y'all. Thanks.